Hi class, just wanted to again upload a quick video on this chapter. In this chapter, we're going to be discussing long-term assets. So what are we talking about here? Long-term, what does long-term mean? Well, these are assets that we've kind of dealt with already. Long-term assets used in a business, we're talking about assets that are typically last longer than 1 year. Obviously used in the business or capable of being used in the business. There's a little thing there. And we're talking about assets that are also tangible. Tangible meaning what? You can touch and feel them. So, assets that typically fall in this category, things like buildings, furniture, automobiles, airplanes, equipment, you name it. So we've already talked a little bit about earlier in the class about what do we do with these assets. Well, we know that with these long-term assets, we typically depreciate these assets. I just wanted to reiterate though, what is the meaning of depreciation? Because there's a lot of misunderstanding about depreciation in a way. Depreciation is really just an accounting creation. Depreciation really is the technical term for depreciation is really just the systematic allocation of the asset's cost to expense over time. I like to think of depreciation as recording the loss of usefulness of the asset over time. And if you think about, for instance, like an automobile or a piece of equipment or even a building, over time that asset slowly starts to wear down and lose its usefulness. And that's really what depreciation records. The biggest common misconception with depreciation is that it somehow records a loss of market value. That's actually really not true. Depreciation in an accounting sense doesn't track market value, even though that's the common thought about it. And the reason is because not all assets in a real sense depreciate in terms of market value. I mean, for instance, like a building, you might buy a building, it might actually appreciate in value, or it might go up. So it doesn't always go down. And also when you think about market values too, market values are very subjective, right? One person's view of what an asset's worth is not the same as somebody else's. So you don't really ever know what an asset is truly worth until you go to sell it, right? And when I say sell it, meaning you actually have a firm commitment in hand as to what an asset's worth. So we don't use market values really very much in accounting at all, and certainly not when we're talking about long-term assets, all right? So, the general idea here is that we always record the asset originally at its cost, okay, at its cost, and then we record depreciation, systematically to expense over time. And we know the entry to that, right? We already know the entry is to debit depreciation expense and to credit the the accumulated depreciation account. And the accumulated depreciation account is just a contra asset, right? It was just a contra asset. So that entry is going to stay the same. In this chapter, what we're going to learn is we're going to learn the different ways of depreciating. There are different methods of recording depreciation. You're going to go through those. I'm not going to go through these in those videos because I think you'll be able to follow them okay. One of them you already know, which is the straight line method. Okay, so we're gonna go through that one again. You're gonna learn a couple more as well. So we're gonna do that. So depreciation is one of the things that you're gonna learn. You're still gonna use some T accounts in this chapter as well. Record entries. Some of these entries you already know. We're also gonna learn about what happens when you go to get rid of the asset in some way. Now you think about it, there's really a lot of different ways to do this. You could you might just get rid of the asset, throw it away. You might sell the asset. You could also trade in an asset, but we're not going to cover that. The accounting entries get a little weird for that. So really just going to focus in this chapter on what happens if you're to sell the asset and what happens if you were just to get rid of it. So make sure to focus in on those. There's, again, T accounts on that will help you a lot. Focus in on the T accounts, on the entries, and you should be okay. I also want to make sure that you also focus in on in your reading when we talk about the cost of these assets. For instance, if you were to buy a building, what incorporates the cost, or a piece of equipment? Well, it really incorporates all of the costs to bring that asset into your business and ready it for use in your business. An example I always like to use is, for instance, like if you're buying a piece of equipment, and let's say you're buying it from out of state. Let's say the equipment costs $15,000. But then it costs another $2,000 to have the equipment shipped to your location. Well, in that case, you take not just the $15,000, but also the $2,000 that it costs to ship the asset to you. So the cost would include both. Also, any taxes, any setup fees, things like that would be incorporated as well into that cost. So the cost of the asset's always the cost plus any cost to ready it for use in your business. So keep an eye on that as well. Also in this chapter, you're going to be looking at some other things too. We're going to talk about things like intangible assets. So assets you can't touch and fill, things like patents and copyrights. Just make sure and read through those really carefully. I don't think there's anything too earth-shattering in there, too difficult to understand. Just got to make sure you understand the differences between those two. We actually do draw those assets down too, similar to depreciation, but we use a different term, a lot of terms and definitions in this chapter. So for intangible assets, we use a term called amortization. It's a very similar concept. And then we're also talking about natural resources, things like mining operations and, natural resources of, oil deposits and things like that. We also record a drawdown of those as well. But we use another term we call depletion. So I know it sounds a lot like depreciation, but it's actually depletion. So don't get too caught up in the terms. You just got to know the difference and which ones they apply to, and the concepts and the entries and the calculations will kind of come online. When you're going through those depreciation entries and any other entries, the actual calculations, it's a really good idea to use a chart, use your key accounts, all the things that you've already learned. You'll see all those in the resources I provided, but it's a really good idea to do that. Again, don't be guessing, don't go too fast, slow down, make sure you get these calculations right. If you have any questions, you know where to find me.